Hi everyone, this is Dao Chai. We are going to be looking at Analyze Business Transaction Part 1. Again, I'm at the Universal Library. If you guys hear students talking, sorry about that. Okay, let's begin. Okay, so inspiration today is going to be from William James. It is our attitude at the beginning of a difficult task, which more than anything else will affect the successful outcome. Okay, so accounting transaction. So to use an accounting information system, you need to know which economic events to recognize, record. Not all events are recorded and reported in the financial statement. For example, suppose GM hires a new employee and purchases a new computer. Are these events entered in the accounting records? The first event would not be recorded, but the second event would. We call economic events that requires recording in the financial statement accounting transaction. An accounting transaction occurs when asset, liabilities, or stockholders' equity items change as a result of some economic event. The purchase of a computer by GM, the payment of rent by Microsoft, and the sales of multiple day Skytrip by Sierra Corporations are example of events that changes a company's asset, liability, or stockholders' equity. Okay, so analyzing transaction, we call the basic accounting equation asset equals liability plus stockholders' equity. Next, analyzing transaction in terms of their effects on asset, liability, and stockholders' equity. Transaction analyze is the process of identifying the specific effects of economic events on the accounting equation. The accounting equation must always balance. Each transaction has a double side effect on the equation. For example, if an individual asset is increased, there must be a corresponding decrease in another asset, or increase in a specific liability, or increase in stockholders' equity. Two or more items could be affected when the asset is increased. For example, if companies purchase a computer for $10,000 by paying $6,000 in cash and signing a note for $4,000. One asset, equipment, increased $10,000. Another asset, cash, decreased by $6,000, and a liability, note payables, increased $4,000. The result is the accounting equation remain in balance. Asset increased by net $4,000 and liability increased by $4,000. Okay, as shown. So asset equals liability plus stockholders' equity. Stockholder equities is common stock plus retained earnings. Retained earnings is revenues minus expense minus dividends. Okay, so we can expand the basic accounting equation. This will allow us to better illustrate the impact of transaction on the stockholders' equity. Stockholders' equity is comprised of two parts, right? Common stock and retained earning. Common stocks is affected when the company issues new shares of stock in exchange for cash. Retained earning is affected when the company recognizes revenue, incur expense, or pay dividends. Okay, so let's look at event 1, right? So investment of cash by stockholders. So October 1st, cash of $10,000 is invested in business by investor in exchange for $10,000 of common stock. This event is an accounting transaction that results in an increase in both asset and stockholders' equity. The equation is the balance of the issuance of common stock. Keeping track of the source of each change in stockholders' equity is essential for later accounting activity. In particular, items recorded in revenues and expense columns and used for the calculation of net income. So event 2, note issues in exchange for cash. So October 1st, Sierra borrowed $5,000 from a bank by signing 3-month 12%, 5,000 notes payable. This transaction resulted in a creation increase in asset and liability. So total assets are now 15,000 and liability plus stockholders' equity is also 15,000. Okay, so event 3, purchase of equipment for cash. October 2nd, Sierra purchased equipment paying 5,000 cash to Superior Equipment Sales. This transaction resulted in equal increase and decrease in Sierra's asset. Total asset now is 15,000 and liability plus stockholder also asset. Stockholders' equity also total 15,000. Event 4, receive of cash in advance from customer. So on October 2nd, Sierra received 12,000 cash in advance from Arnox, a client. Sierra receives cash, an asset for the guide service for multiple day trips that's expected to complete in the future. Although we received the cash, it does not record revenues until it has performed the work. So, such as in other industries like magazines and airline industry, customers are expected to prepaid. So these companies have liabilities to the companies until the delivery of magazines or provide flight. When companies eventually provide the products or service, it records the revenue. Since we receive cash prior to the performance of service, Sierra has liability for the work due. So, event 5, service performed for cash on October 3rd. Sierra received 10,000 in cash and an asset for company for guide service performed for corporation event. Guide service is principal revenue producing activities of Sierra. So revenue increased stockholders' equity. So this transaction then increased both asset and stockholders' equity. So we're looking at so often this will be accounts receivable. Okay, so often companies perform service on account. That is they perform service for which they are paid at a later date. Revenues, however, is recorded when services are performed. Therefore, revenues would increase when services are performed, even though cash has not yet been received. Instead of receiving cash, the company receives a different type of asset, the accounts receivable. Accounts receivable represents the right to receive payment at the later date. Suppose that Sierra performed these services on account rather than for cash. This event would be reported using the accounting equation. So later, when Sierra collects the 10,000 from the customer, accounts receivable will be decreased by 10,000 and cash will be increased by 10. Note that in this case, revenues are not affected by the collection of cash. Instead, Sierra records an exchange of one asset, accounts receivable, for a different asset, cash. Okay, so event 6, payment of rent. So October 3rd, we pay its office rent for the month in cash, 900. The rent payment is a transaction that results in a decrease in asset, cash. So rent is a cost incurred. It affects its effort to generate revenue. So rent is cost incurred by Sierra in its effort to generate revenues. It is treated as an expense because it pertains only to the current month. Expense expense decrease stockholders' equity. Sierra's record the rent payment by decreasing cash and increase expense to maintain the balance of the accounting equation. So right here, event 7, we're looking at purchase of insurance policy for cash. So on October 4th, paid $600 for 1 year of insurance policy that will expired. On September 3rd, payment of expense that will benefit more than one account prior identifies asset called prepaid expense. And then the balance is total asset. All right, did not change. One asset account decreases by the same amount that another increases. Okay, so event 8, purchase of supplies on account. So right here we are looking at accounts payable. October 5th, purchase and estimate 3-month supplies on accounts, right, from Arrow for $2,500. In this case, on account, meaning that the company receives goods that it will pay late on a later date. This transaction increased both asset and supply and liability, right? Okay, so the hiring of new employees, right, October 9th. So on this date, Sarah hired employee, there's no effect on accounting equation because the asset, liability, and stockholders' equity of the company does not change, right? So just take a quick note of that. All right, so event 10, so payment of dividends, right? So on October 20th, Zero paid $5,000 cash. Dividends are a reduction of stockholders' equity, but not an expense. Dividends are not included in the calculation of net income. Instead, dividends is a distribution of company's assets to stockholders. Okay, so event 11, so payment of cash for employee salary. So now we do something about that hiring. So employees work 2 weeks, earn $4,000 in salary, which pay on the 26th. Salaries are wages, expenses, and expense to reduce stockholders' equity. In this transaction, both asset and stockholders' equities are reduced. Okay, so here's a quick summary, right, of the transactions of the corporation to show the cumulative effect on the basic accounting equation. So the point to take out of here is each transaction is analyzed in terms of effective asset, liabilities, and stockholders' equity. The two sides of the equation must always be equal. The cause of each change in stockholders' equities must be identified. Okay, so you guys wanted to pause here and take a look at that. Okay, all right, thank you.